Ever wonder if you're doing all you can to minimize your tax liability? It's a question that crosses the mind of many, especially as the tax season looms. The world of taxes can be a maze, but worry not. We're here to guide you through it, breaking down complex tax-saving strategies into simple, digestible chunks. We'll explore the ins and outs of your income and how it affects your taxes. We'll delve into deductions, those magical reductions that can significantly decrease your tax bill. We'll also discuss tax credits, a dollar-for-dollar reduction in your tax liability. And let's not forget about choosing the right filing status, an often overlooked but crucial part of the tax-saving equation. Our aim is to help you understand these strategies so you can implement them effectively and maximize your take-home income. So, are you ready to dive into the world of tax savings? It all starts with understanding your income. Now this may sound simple, but it's more intricate than you might initially think. Income isn't just the paycheck you receive from your 9-to-5 job. There are different types of income that are taxed differently, and recognizing them correctly can help you maximize your tax savings. Firstly, we have earned income, which includes salaries, wages, tips, and other taxable employee pay. This is the income that you earn by working. It's usually the one people are most familiar with, and it's subject to federal income tax, Social Security tax, and Medicare tax. Next, we have business income. If you own a business or are self-employed, the net income from your business operations is considered your business income. This income type is subject to self-employment tax, which covers Social Security and Medicare taxes. Then there's investment income, encompassing interest, dividends, and capital gains. This is the money you earn from your investments, like stocks, bonds, or real estate. The tax rate for this income type can vary greatly, depending on how long you've held the asset and the nature of the investment. Lastly, we have passive income. This is income generated from activities in which you're not actively involved, like rental properties or businesses you own but don't manage day to day. The tax implications for passive income can be complex and vary depending on the specific circumstances. It's crucial to understand these income categories because each one is taxed differently. For example, long-term capital gains, that's profit from selling an investment you've held for over a year, are taxed at a lower rate than ordinary income like your salary. So understanding how your income is categorized can help you anticipate your tax liability and plan accordingly. In the end, it's not just about how much money you're making, it's about how you're making it. And the more you understand about the different types of income, the better equipped you'll be to make tax-smart decisions. Knowing your income type is the first step towards a better tax-saving strategy. Deductions, an essential tool in your tax-saving arsenal. Now you might be wondering, what exactly are tax deductions? Well, in the simplest of terms, tax deductions are expenses that you can subtract from your gross income. This in turn reduces your taxable income, which could potentially lower your tax bill or increase your tax refund. Now let's delve into some common deductions that you probably encounter in your everyday life and see how they can work in your favor. First on our list is mortgage interest. If you own a home, the interest you pay on your mortgage is usually deductible. This deduction can be a significant tax saver, especially in the early years of a mortgage when most of your payments go towards interest. Next, we have student loan interest. For many of us, education doesn't come cheap, but the silver lining is that the interest paid on student loans can often be deducted, helping to ease the financial burden of those school loans. Now let's talk about retirement. Contributions to certain retirement accounts like a traditional IRA or a 401k can be deducted from your gross income. Not only does this help you save for your golden years, but it also reduces your taxable income now, which is a win-win situation. But remember, these are just a few examples. There are many other potential deductions out there, from medical expenses to charitable donations, and even certain job-related expenses. The key is to keep track of these expenses throughout the year. Maintain good records and receipts. They're your best friend come tax time. The world of deductions can seem complex, but it's well worth exploring. Making the most of your deductions can save you a significant amount of money. And who doesn't like to keep more of their hard-earned cash? In the end, it all boils down to being aware and staying organized. So, as you go about your daily life, keep an eye out for potential tax deductions. They're everywhere if you know where to look. Remember, every deduction counts. Tax credits, your secret weapon against high taxes. Imagine them as a shield, deflecting some of the blows that the taxman might otherwise land on your hard-earned income. So, what's the difference between a tax credit and a tax deduction? Well, deductions lower your taxable income, while credits reduce your tax liability dollar for dollar. Think of it as the difference between lowering the cost of a meal and getting a coupon for a free dessert. Both save you money, but one gives you more bang for your buck. Now let's dive into some of the common tax credits you can utilize. First up, the Earned Income Tax Credit. This one's designed for low to moderate income working people, and the amount varies based on your income and how many children you have. It's a refundable credit, which means that if it reduces your tax liability to below zero, you could get a refund. Next, we have the Child Tax Credit. If you're a parent, this one's for you. For each of your children under 17, you might be eligible for a credit of up to $2,000. And up to $1,400 of this is refundable. Now what about those of you hitting the books? Education credits like the American Opportunity Credit and the Lifetime Learning Credit can help offset the costs of higher education. The American Opportunity Credit can provide a credit of up to $2,500 per student for the first 4 years of higher education. The Lifetime Learning Credit, on the other hand, offers up to $2,000 per tax return for any level of post-secondary education and for courses to acquire or improve job skills. Keep in mind, tax credits are subject to income limits and phase-outs, so it's important to check the specific rules for each one. But when used strategically, they can significantly reduce your tax liability. Tax credits can be a game changer in your tax-saving strategy, so don't overlook them when planning your finances. It's time to wield your secret weapon and shield yourself from high taxes. Choosing the correct filing status can make a big difference. When it comes to tax savings, it's not just about how much you earn or the deductions you can claim. Your filing status plays a crucial role too. There are 5 primary filing statuses: single, married, filing jointly, married filing separately, head of household, and qualifying widow with dependent child. Each one comes with its own set of tax rates and standard deductions. For instance, the married filing jointly status typically offers the lowest tax rate and the highest standard deduction, making it a popular choice for couples. On the other hand, the head of household status may be a better fit if you're unmarried, pay more than half the costs of keeping up a home, and have a qualifying person living with you. So, don't just check off any box. Take a moment to understand what each status means and how it can affect your tax savings. Your filing status is more than just a box to check, it's a key part of your tax-saving strategy. Let's take a moment to recap what we've learned today. We dove headfirst into the world of tax savings, exploring strategies and tips designed to help you keep more of your hard-earned money. From understanding your income to utilizing tax credits, every bit of knowledge is a step toward maximizing your take-home income. In our journey, we first unpacked the concept of income. We learned that comprehending the nuances of your income is fundamental. It's not just about how much you earn, but also about how you earn it. Salary, dividends, capital gains, they all have different tax implications. Knowing this helps you strategize better and make more informed decisions. Next, we delved into the realm of deductions. We discovered the power of deductions in reducing our taxable income. From mortgage interest to charitable donations, there are a multitude of potential deductions available. The key is to stay informed and claim what's rightfully yours. Then, we explored the world of tax credits. Unlike deductions, tax credits reduce your tax liability dollar for dollar, making them incredibly valuable. We have tax credits for a range of activities, from education expenses to energy-efficient home improvements. The more you know, the more you can benefit. We also discussed the importance of choosing the right filing status: single, married, head of household. Each status has different tax brackets and deductions. Choosing the correct status can have a significant impact on your tax bill. It's not a decision to be taken lightly. And there you have it. We've navigated the labyrinth of tax savings together, uncovering strategies to help you maximize your income. Remember, tax saving is not a one-time effort. It requires consistent attention and planning. But with the strategies we've discussed today, you're well on your way to maximizing your tax savings.